Hi there, good morning. You're watching Market Cafe on ET Now. The kind of move what we saw yesterday on Indian markets, all sectoral index closed in red mark. We barely managed to close above 23,000. Another big selling, a big quantum of FIs are selling. What do that means for markets today? What are the kind of cues that we're gathering from US, from Asia, and what would be the buzzing stocks? We'll get you all that in 1 hour so that we set you up for the trading day today. Well, let's just understand first what are the cues that we're getting from US markets. Now, the tariff trade tension is keeping US markets also in check. So if you look at the move, what was registered yesterday, mixed set of cues was coming from US markets. Nasdaq fell, S&P was flat, and Dow barely managed to close with a minor gain. So a mixed set of cues, and of course the kind of commons markets the traders are eyeing on, what Jeremy Powell has to say on this, CPI figures, economic front, all that is actually drawing a cautious picture right now from the markets because one of the members from the Fed committee also mentioned that they are not in a hurry to do further interest rate cuts in the market, and that's what we saw. Tariff trade tension that kept the market in check. Wall Street just braces for now January inflation print. Trade war is what is keeping the market in check right now, and similar kind of move what we saw from the Asia Pacific market also yesterday. US indices barely managed to closed with a gain. Actually, it was on a flat note for S&P, and Nasdaq rather fell yesterday. Key earnings which are to be reported this week, but the more focus is on the CPI front as well as the Fed comments which would be coming in today on Wednesday morning as per US time. Treasury yield, that one was higher on Powell's comment yesterday because, of course, what the kind of comments what was made was negative for equity markets and positive for the bond market. The combination, let's understand. In fact, crude also fell yesterday. Moving on, let's understand the kind of move what we saw for oil prices. Oil prices rise yesterday because there are tensions which are being mounted on supply concerns at the moment. Gold, what we saw, has already hit the 8th record high this year. It was again on a record high yesterday because, of course, whenever a political instability happens, economic instability happens, then bullion is a safe hedge always. So let's get you the figures for gold also, that how gold was trading yesterday. We saw that it is nearing to 3,000 per ounce mark, but yet some more days, maybe some more steps to cover that mark. But at the moment, gold is up, yields are up, but equities is facing the brunt. The tariff trade tension is what we see.Moving on, let's get you more news on the front of the global stories now. We've seen the kind of move which came on US markets. Crude we have spoken about, but now talk about the other stories, and let's kickstart this coverage with the comments coming in from the Federal Reserve Chief Jeremy Powell. And in his first appearance before the Congress since the inauguration, vouched for the strength of the economy President Donald Trump inherited even as he deferred on questions about tariffs. Elon Musk's role in government, bank account safety, and other issues reflecting the unsettled nature of the administration's first weeks. Lauding the strength in the numbers, Powell noted that the Fed was in no hurry to make any further interest rate cuts, but were ready to do so if inflation declines further or the labor market weakens. Detailing the rationale, he added that moving too fast on rate cuts could in fact hinder the progress on inflation. Moving on, talking about the US CPI, the big data point we will be tracking later in the day today would be the January CPI report, which is likely to tell a familiar story. Another month, another expected miss for inflation as it relates to the Federal Reserve's goal, with concerns aplenty about what happens from here. CPI is likely to inch up 0.3% for the all items index and a 12-month inflation rate of 2.9%. The latter the same as December. Excluding food and energy, the respective core readings are projected as 0.3% and 3.1%. The annual mark just a notch down from the 3.2% reading in the month of December.
Alright, then moving on, at the Global AI Summit in France, the US and UK have not signed an international agreement. Now, in a statement, Downing Street said that it will sign initiatives which are of national interest. And meanwhile, you do have US Vice President J.D. Vance also said before that over-regulating artificial intelligence will be killing a transformative industry. And there was some key commentary coming in from him earlier. Remember that 61 countries have already signed the AI declaration, including the likes of France, China, India, Japan, Australia, as well as Canada.
Okay, with this, we stay for a short break here. When we come back, we track the Asian markets for you and all the buzzing stuff that you have to treat, you have to track so that we set you up for the day today.
Welcome back. Thank you so much for staying tuned in. Well, as promised, let's get your check going on what the Asian markets are up to at this point. And when you take a look at Asia, it's quite the mixed bag at this point. Hong Kong's Hang Seng Index, that's the one that is holding on to a shade of green, 0.6% uptick coming in. For that one, 0.7% uptick there on your screens at this point. And when you take a look at Australia's ASX 200, now that's the one that's up just about 0.2% at this point as well, fluctuating between an uptick of 0.1% and 0.2% on your screen as well. And when you take a look at Japan's Nikkei as well, that is also the one that has come back after a holiday, and that's the one that's holding on to a tinge of green as well, 0.2% uptick for that one. On the flip side, you do have South Korea's Kospi as well as Shanghai that are on a little bit of a back foot at this point. So you do have South Korea's Kospi that's down 0.6%. Shanghai as well down just about 0.1% at this point. Now, when you take a look at the markets back home, then you do have Nifty that shut shop around 23,000 levels, and currently what is being penciled in is quite a decent start. So it's a mixed bag coming in from Asia, but Asian indices trading largely in the green at this point. Nothing to write home about the handover coming in from Wall Street, but regardless, you do have a decent start that we're penciling in, Priyanka.
Decent start. Okay, so mixed set of cues, but Hang Seng has been on a surprise. Last week, if you notice, last 5 days, Hang Seng has rose the most, whereas Indian markets have fell the most if you compare the rest of the world and the India. GIFT Nifty also implying maybe we could see a soft, a fresh start, maybe at 29 points up, what GIFT Nifty is indicating at the moment.
Welcome back. Thank you so much for staying tuned in. Well, time now to get you some more news and updates. And when we do that, let's take a look at the macro data point that the street is closely eyeing. India's retail inflation is expected to fall to a 5-month low in January, largely driven by easing vegetable prices. In fact, Gaurav is standing by to tell us exactly what is being penciled in.
Well, yes, inflation in India was one of the biggest concerns, and because of which we saw rate cut was halted. But after that, now recently we saw RBI has went ahead with rate cuts. They have cut the rates almost by 25 basis points because they also see that inflation is likely to ease. And when we look at economists, they also view that CPI inflation for the month of January is likely to come somewhere near 4.6%, which will be at the lowest level if we compare it for the last 5 months. Other than that, the range also comes from 4.2% to 5.1%. And what economists say is that the fall in inflation is much likely because of the food inflation, which is likely to ease. Cooling vegetable price inflation is something which will actually contribute to this segment. And at the same time, they also say that fresh winter crops are actually one of the reasons why inflation is likely to ease even further. Apart from that, when we look at core inflation, we have already seen that this number has remained well below 4% for the last few months. And after that, in this month of January also, they believe that this will remain below 4%, but we may see a little uptick. Core inflation may come somewhere near 3.7%. Let's also not forget that now what economists believe is that we have already seen that RBI has cut their interest rate, and with inflation easing, they believe that because of this move, RBI will get further room for improvement in the economic growth. Let's not also forget that RBI also cut their inflation estimates for Q4 almost by 10 basis points, and after that we are seeing some positive uptick coming up from economists as well. So definitely watching out on how the CPI numbers come out and how the number pans out for India in terms of inflation tomorrow.
Okay, thanks very much, Gaurav, for that fine print on India inflation trajectory. CPI awaited, and of course, rate cut was taken in the last meeting. Let's see if the inflation is also as per the estimates of the RBI. Moving on, Finance Minister Nirmala Sitharaman, speaking at the Lok Sabha, addressed the volatility in rupee-dollar exchange rate. She said that the value of rupee against dollar is influenced by a combination of global as well as domestic factors. She listed down factors like movement of the dollar index, level of interest rate, and even the capital flow trends. Listen into what exactly she said.
If you look at the real effective exchange rate of the rupee, it has not depreciated that much. Some nominal depreciation might be useful for exports. Various domestic and global factors influence the exchange rate of Indian rupee, such as the movement of dollar index, trend in capital flow, level of interest rates, movement in crude prices, current account deficits, etc. So the currency volatility across major countries is really extensive, sir. You get information on that. The US dollar index rose 6.5% during October 24 to January 25. Are you, sir? Usme bhi aa rahi hu. हाँ, आ रही हूँ. Major Asian currencies such as South Korean won, Indonesian rupiah, Malaysian ringgit depreciated by 8.1%, 6.4%, and 5.9% respectively in this period. G10 currencies, sir, also depreciated during this period by more than 5.5%. So, for instance, Japanese yen depreciated by 7.0%.
Alright, then let's get you some more interesting commentary coming in then from India Energy Week. In fact, my colleague Prakash Priyadarshi then caught up with Petronet LNG's MD and CEO Akshay Kumar, and he talks about LNG demand as well as the potential that India has to back mega LNG deals as well. Let's go across and listen in to what else he then had to say about both India's placement when it comes to the pecking order in LNG as well as the expansion plans that the company has.
There is a lot of appetite and potential in our country to get some attractive LNG deal from the international market, and all the stakeholders in these fields are active to secure such a deal.
And if you could share some details about your future expansion plans.
Yeah, this Dahej terminal we are expanding from 17.5 million ton per annum to 22.5 million ton per annum, which is going to be commissioned very soon. It is at advanced stage of the completions, and also we are in the process of setting up one East Coast LNG terminal in Gopalpur in the state of Odisha. The capacity will be 5 million ton per annum. And our Kochi terminal, which is currently being utilized only at 20-22%, we expect that once it is getting connected through the pipeline at Bangalore, which is also being laid by GAIL, and our expectation in this year that pipeline will be completed. So that will also help us in utilizing the capacity of Kochi terminal.
All right, that was an exclusive with Petronet LNG. But at the India Energy Week, which kick-started off yesterday, ET Now's Prakash Priyadarshi did caught up with the renewable chairman Sumant Sinha also on India's 2030 vision for clean energy. He says that 70 gigawatt solar module capacity is sufficient to support the goal of 500 gigawatt of renewable energy for India. Listen in.
Every year we'll be adding about, let's say, 40 gigawatts of solar, for which we'll need about 55-60 gigawatts of solar modules. So I think having a manufacturing capacity of 70 gigawatts is actually quite good in that respect. We'll have a pretty balanced demand-supply situation. So I think it's good that we have that kind of manufacturing capacity.
Or any sort of policy-related reforms that you'd like government to undertake at this point of time, especially in the context of we have a new administration in the US, and there is some supply-side constraint, especially when it comes to China. So do you think that the government should come out with some sort of new policy measures?
I think that the government's policies have been very good so far, both in setting up IPP or megawatt capacity to generate power on a clean basis, as well as now to indigenize the supply chain. So I think they've done a pretty good job so far. And I think the guidance for the future also is that we need to have more domestic manufacturing to make sure that we have better energy security. Prices are already quite low for clean energy. So I think all of that means that we'll have a fully integrated, end-to-end clean energy chain in the country.
Alright, then moving on, Novama hosted the 20th India Conference where the theme was India reformed, resilient and resurgent. In fact, with 700 clients meeting 190 companies over 3 days, that's what the conference looked like, where Shiv Diwan, who's the MD and head at Novama Institutional Equities, is seeing the froth in the market. Let's try and decode his perspective when it comes to the froth in the market, then go across and listen in to what he then had to say.
I don't say that the froth is settled. It's definitely coming off, and we are coming back to a reasonable level. But we're still midway through that process. So I won't say it's over and we should start buying immediately. I think, like I said, it is in certain sectors, it's definitely sort of come off. But in a few sectors, it's still there, and we are in the process of seeing some of that shave off as we go ahead. You will see pockets of growth emerging and pockets of stocks which will start to look very attractive in the next few weeks, months, and that's so. Yeah, it's good to get your shopping list ready.
All right, we'll keep getting you more from the Novama conference. That's the overview what Mr. Diwan was talking about. Moving on, SIPs, systematic investment plans, have been sold as the best way for retail investors to ride out market ups and downs. The idea is simple: invest a fixed amount regularly, and rupee cost averaging will smooth out the highs and lows, helping you build wealth over the time. Sounds great, right? But what happens when markets enter a prolonged downturn? History tells us that SIPs haven't always worked as expected. There have been long stretches like the time period from 1994 to 2002 and even for 2006 to 2023. SIP investors in mid-cap stocks saw little to no gains or even lost money. Despite the recent correction, investors continue pouring money into mid and small cap funds, often ignoring warnings about valuations. Are SIPs truly a safe bet in a bear market, or is blind faith in them leading investors into a trap? We caught up with market expert Sunil Subramaniam and even Anurag Singh, managing partner for Ansiddha Capital, to know their views. Listen into what exactly they had to say.
Volatile market, right? The rupee cost averaging that means that you buy more units when it's down and you buy less units when it's up. Now, the working of SIP depends on the maturity date of the SIP. Normally, SIPs are done to achieve certain goals, like a child's education abroad, or a wedding, or you want to go on a silver jubilee, wedding anniversary cruise. So you save for a period. Now, if that maturity date happens bang in the middle of a bear market, right? Depending on when you started the SIP. So if you've done 5-year SIPs, there are equal chances that in the midst of a bear market, you would have lost your money relative to the amount that you put in. But the moment you stretch that to 10 years and 15 years and 20 years, even in bear markets, even if it started in the highest bull market, you still made decent returns. So I think that the answer, to be very simple, is that short-term SIPs less than 5 years stand the risk of you losing money if you're stuck with the maturity in the middle of a bear market. But if you see through the bear market, that investment in the bear market would have been your best value installment ever.
I'm very skeptical of experts and market gurus who say, stay for 20 years, you are guaranteed to gain. And in the same breath, people say past performance is not a guarantee for future. I don't think anybody can guarantee anything here, right? First point to note is, even if you say, oh, 20-year time, it has always worked because it has worked in the last 20 years, that doesn't hold true, right? So please be skeptical of that. First point. Second, Vikram, SIP analysis in India is a hindsight phenomena. Because nobody did it, market had prolonged bear phases of 7, 8, 10 years. Markets were extensively cheaped. If you virtually in the hindsight go back and allocate money at that level, obviously you will come out very rich today. It hasn't worked anywhere except India. Even there, experts are being disingenuous because they count 2002 to 2008 phenomena. The moment you take that phase out, even in India SIP, the case is very weak.
All right, then time now for a very quick breather on the show. But as we do that, take a look at the power pack lineup that we have for you on the market.
Welcome back. You're tuned into Market Cafe on ET Now, and let's get you all the action from the derivative space. Ansh is joining in. Ansh, no respite seems to be coming in. Lower strikes, spot puts being bought on Nifty, Bank Nifty. Shorts position have been added. Another big quantum of FI selling has come in. Tell us all the action.
Well, we saw market cap erosion of around 9 lakh crore. Also, if we talk about Nifty, then that has been declining for 5th consecutive session. But the good thing is that it at least sustained about that psychological mark of 23,000 on a closing basis. But if we talk about index options, then we are seeing strong call writing happening at that 23,300 strike, indicating very strong resistance around this level. So if we see an up move, this is the level where we may face very strong selling pressure, which is around 300 points away from its current level. Whereas on downside, we are seeing very active put buying happening directly at 22,700 mark, indicating some put buyers are getting optimistic on downside that they are expecting Nifty to go around this level or even fall below this level. So we may see some good volatility in the market. At the same time, if we talk about Nifty Bank, then here also we are seeing that index has been declining for 3rd consecutive session. It has also given a break below that 49,500 mark, indicating negative sentiment in this index as well. Also in index future, we are seeing open interest has gone up by around 15%, indicating short build up. Also, if we talk about now FI position, then in previous session we saw that in index future they have added around 11,000 contract on downside, due to which the total long position has slipped down from 14.8% from 14.8% to 14.2%. So they also seems to be getting bearish in this market.
Thanks, Ansh, for getting us that update then. But while you're with us, MSCI then in its February rejig added Hyundai and excluded Adani Green. In fact, they've also hiked the weightage when it comes to IndusInd Bank as well as Zomato. And the adjustment, I believe, is likely to kick in from February 28th. Tell us a little more about this rejig as well.
Well, that's right. According to IIFL All Desk reports, we are seeing that there are big changes in the MSCI index expected, set to take effect from 28th Feb. Now, starting with the MSCI India Standard Index, a key addition this time would be Hyundai Motors, which is expected to see an inflow of around $255 million. On the other hand, a major exit, Adani Green Energy, which will be removed from the index, triggering an estimated outflow of around $167 billion. Apart from this, several stocks will see weight increase. IndusInd Bank is the one which is leading this pack with an estimated inflow of around $258 million, followed by Varun Beverages, seeing an inflow of around $96 million, Mankind Pharma, $48 million, PB Fintech, $32 million, Torrent Pharma, Torrent Power, and Zomato also in the list. Now, if we talk about MSCI Index, Small Cap Index, there we are seeing there would be around 19 additions and deletions in the latest review. Lastly, it is worth to note that India's weight in the index now stands at around 19%, which is down from its 19.8% if we compare from its November 2024 review. At the same time, if we talk about China's weight, then that has gone up slightly to 27.1% from its current 26.8%.
All right, so let's see how these stocks react on this particular news on MSCI changes. Thanks for reflecting that, Ansh. Moving on, we have Ria standing by with a list of stocks that could be buzzing in the trade today on the back of news as well as earnings. Ria, morning.
Yes, good morning. Let's take a look at the stocks that are going to be in focus today. First up, we have Lupin reporting quite a good set of numbers. Revenue has gone up around 10.5% on a year-on-year basis. Even the EBITDA has seen a good growth of 32% over the previous year, and margins have come in at 25.1% in this quarter versus 21% in quarter 3 of last year. The net profit has also seen quite a good increase of 38% over the previous year. Further on Lupin, the board has also approved the transfer of the OTC consumer healthcare business of the company on a slump sale basis to a wholly owned subsidiary that is proposed to be incorporated, and this wholly owned subsidiary will be called Lupin Life Consumer Healthcare Limited. Moving on to IRCTC, they've reported quite an operationally weak set of numbers. While the revenue has gone up around 10% on a year-on-year basis, and net profit has also seen an increase of almost 14%, the margins have fallen about 130 basis points, coming in at 34% in this quarter. Going on to NBCC, a good set of numbers coming in here. Revenue has gone up more than 16% over the previous year. Net profit has also seen quite a good growth of 25% over the previous year, and margins have also seen a slight expansion of 20 basis points. Berger Paints has reported an inline set of numbers. Revenue has gone up just about 3.2% over the previous year, and they've also seen high single-digit volume growth in the decorative paint segment. They've also seen a sequential uptick in both value and volume, and the company has said that they have continued to gain market share in quarter 3, and the current market share is in excess of 20%. So inline set of numbers coming in for Berger Paints. Ircon International has reported a very weak set of numbers. Revenue has gone down over 11% on a year-on-year basis. Even the net profit has gone down 65% over the previous year, so very big cut coming in here. EBITDA is also down around 50% over the previous year, and margins have fallen by 378 basis points, coming in at just about 5% in this quarter. Shifting away from earnings though, Cyient DLM will be in focus. The company has signed a production contract with Boeing Global Services for precision machine parts and assemblies. BEML will be in focus since BEML and STX Engine Forge have forged a strategic partnership for advanced defense and marine engine solutions. BHEL has received a letter of intent from DVC for a steam generator island thermal power station phase 2 project, and the quantum of this order is rupees 6,200 crores, a very significant order coming in for BHEL. And lastly, also keep your eye out on TVS Motors, since they have signed an MOU with the Karnataka government to set up a global capability center in Karnataka, and they will also be expanding their operations in Mysore. So keep your eye out on all of these stocks today.
Absolutely, Ria. Thanks for getting us that update. We'll keep an eye on all of those counters that you've highlighted for us. But speaking of stocks, then let's also talk about the counters that make it to brokerage radar bright and early this morning. In fact, Jenna is standing by with just that list.
Well, yes, couple of stocks in focus on the brokerages report. First up, Apollo Hospital. Nuvama have retained their buy rating with a target price of 8,200. Now, what they say is the company is geared up to post a 15% revenue growth on the back of occupancy level, which seems to increasing closer to 72%. Also, the management is confident on maintaining the 24% margin as the Kolkata and Delhi facility now achieves break even. However, there is a slower than expected growth and ramp up in 24/7 business, and that is why Nuvama have cut 26 and 27 EBITDA estimations by 3 to 5%. Talking next, Birlasoft will be in focus. Nuvama, they've maintained their reduced rating at the target price of 465. Now, what they believe is that the company continues to disappoint with their result, and they also believe that revenue will decline in Q4 as well, mainly because of furloughs extension and the client ramp down, and that is why they're cutting down the 25 and 26 estimations sharply by 5 to 10% range. Moving on, Devyani International, that will be in focus. Nuvama again maintains buy rating with the target price of 240. If you talk about the Indian business specifically, they had recorded another weak set of numbers. However, if you talk about KFC business, that was the key weak driver as company achieved a negative same-store sales growth. And talking about management, they remains bullish on this KFC business, and they will continue to further invest into the brand building. Talking about the Thailand business, that has surprised or have sequentially performed well in despite of geopolitical situations. That is why they maintain buy rating.
Thanks very much, Devyani International, Apollo Hospital, Birlasoft, many counters wherein a view coming in a little conscious, and even Nuvama has reduced the rating also. But moving on, with this, it's a wrap on this edition of Market Cafe. But before we let you go, we'll get you an interesting conversation. Asset allocation is more important than chasing stocks and sectors. This is what ICICI Prudential's Nareen has to say in an exclusive interaction with ET Now. Remember, he has been caught in a storm after cautioning against small and mid caps, asking investors to stop SIPs. He clarifies what he meant, and there is no cause for panic. Listen in.
How many people are 20-year SIP investors? That is the challenge of what I have seen in the markets, and that is the biggest challenge at this point of time. And I was surprised. Last week I had a talk in a FIFA IFA event. So they presented me a book written by Devina Mehra. I opened the first chapter. It says asset allocation is more important than stock picking. I was so happy to see that, and that is the reality. Everyone is obsessed about stock picking, but asset allocation is what determines everything. And people have just ignored debt in the last 5 years. If you go and tell anyone that debt is an asset class, and my CIO debt is never called on by any channel to talk on debt, that is the reality. But so asset allocation is more important than stock picking. How to convey it to people? And that is the reality. And luckily, I would say, 2 years back, my CIO debt helped me in saying that we have to push multi-asset, which had gold in it. If that was not done, I would have said that it was one of the best investment decisions that happened. And it was because of both of us that we actually realized that gold is a very good asset class. So I believe, the amount of effort that people spend in asset allocation in this country is much lower than what they spend in stock picking. In stock selling, I don't know what they spend. They spend in stock picking.
What is the right allocation in this kind of a market where valuations exactly are not attractive, but the long-term growth prospect is still very strong? I mean, what should be a right allocation for next 3 years, 5 years, and 5 years beyond?
Is very tough at this point of time. The hunt for an undervalued asset class is too tough at this point of time. That is why in many of the events, I feel that bank FD and debt mutual funds look to be the most undervalued, because they're the ones which have done very badly in the last 5 years. Normally when I look at it, and I would say office yields are the third, which look very attractive. So, normally when you do asset allocation, you have to identify the worst performing asset class on 5 years. So, on that basis, we've been recommending bank FD, debt mutual funds, and office, because office yields are better than residential yields. So these are the three areas which look the best at this point of time. Office yields, because of this work from home, which was possible in many areas, and going away, that was an area which underperformed. So these are the three areas which look interesting, and that is a framework, but otherwise it depends on your risk appetite, etc.
So Naren, you said debt is looking good, but why is debt looking good when dollar is weak? Why is debt looking good when global uncertainties are there? Why is debt looking good where in general that the macro environment is challenging?
You have to remember that cash has a value. Normally I'll tell you, this is something my colleague Manish, the debt CIO, and me keep discussing. Normally, when everything is overvalued, you normally put money in gold. And what happens is, but this time, gold has gone up faster than every other asset class. So you can't put money in gold. So where do you put money? You have to put money in debt. So the reality is, in fact, last week, we are subscribers to Gavekal. And Gavekal has said that there are three asset classes which seem to be going together, which is all the FANG stocks, dollar, and gold. So he's saying that these three can go down together. So it's very interesting. Normally, in a framework of asset allocation, when asset classes are costly, we would put money in gold. This time we have to put money in debt or cash. And in US, for example, one of the investors we all admire, he has the largest holding of treasury bills today. So taking a cue from him, you have to put money in debt at this point of time, not put money in gold, because gold has gone up substantially. So you don't put money in an asset class which is at all-time high at this point of time and say that is asset allocation.